couple of housekeeping notes first. I mentioned, I think in the announcement, most of these, but one is office hours. I'm figuring out my schedule more, and what I'm finding, since of course we can't have in-person office visits, that probably the best thing to do, and my schedule kind of keeps moving around. Um, two ways for office hours. One, just send me an email and we'll schedule it. I'm usually on the computer for at least part of every day, so I'll be happy to do that. Preferably not at 11 o'clock p.m., half an hour before the weekly quiz is due. But other than that, we can usually work something out without too much notice. And then the other thing is, I've gotten the habit over the summer with my PMBA financial modeling class of just most of the time leaving on my Zoom camera while I was in the office, here or at home. And so you can also check that through the personal meeting room and just see if I'm there. And if I'm there, it means that I'm, similar to just being in my office with the door open. I'm happy to chat then as well. So your choice, either one. And then of course, as always, email questions, comments, issues. I got a few from you all this week, as well. Class sign up. I'm not going to clearly need you to sign up to make sure we haven't reached capacity. I may start asking you to sign up if you're going to attend class, so I know whether there is going to be actually 0 people here, and that way I can run the video production facility from my office instead of classroom. On the quiz scores, it should have taken effect in ELC. You'll notice that I've dropped your 2 lowest quiz grades, and we've of course only had 3, and so that obviously which one's the lowest may change as the course goes on, but those last 2 are dropped, so that should be reflected in your score, which is of course under grades. Comment on the LBO project. I posted the schedule. I think I kept it mostly the same, except I maybe moved the due date of one of them back to a day later, but it's a week when you won't have a homework quiz. And the only other thing I've added, we talked a bit about, and we'll talk more about the what type of company you pick, but one I would add to the list that I may or may not have talked about, and that is try to get somebody who's doesn't have too complicated of a balance sheet or income statement for that matter. And so I would tend not to try to do a leverage buyout on financial institutions like a bank, a broker-dealer, like Schwab or somebody, an insurance company. Insurance brokers might be okay if you're in the insurance program and are interested in exploring that. And the reason is there's just so much going on with publicly traded companies who are in those kind of businesses. A lot of not strange items, but more complicated balance sheets. And even, for example, with Harley Davidson, one you cannot use because we're going to be using that in class starting today, they've actually got a financial group which loans money to people who are buying Harley Davidsons motorcycles. And so there's short-term debt, long-term debt, obviously the assets are the receivables, and for the Harley riders who don't die from going to Sturgis and getting Covis, who will be able to pay them back, that it will be an asset. And that just makes things more complicated. And that's why you'll see when we go through HOG, I've referred to and will refer to, we'll get most of our financial information from Morgan Stanley's research report, because they've sort of cut through that for us. And rather than sending you back to the 10Qs and 10K, the publicly listed financials or reported financials, and have you sort through this, they've really done that for us. So that's why I felt comfortable using using them. And in fact, if you end up with a company that has some of that complexity and want to use Wall Street research to sort through it, as we are going to do with Morgan Stanley, that's okay as well. You just have to make sure you refer to it. The only disadvantage of that is that this won't be a course where we spend a lot of time learning how to obtain information from the SEC filings and so forth, which hopefully you've done in other courses, but it won't be added to the learnings for this course. And groups, again, I mentioned the thing that's the maximum of 3. You can go across classes if you want. By that I mean this class and the one immediately after this. You're all in ELC together as one course. So if you've got a contact or somebody from the other group that you'd like to be added to, 3 maximum. If you want to do it as 2, that's fine. We all know that only 1 or 2 people do all the work anyway, right? So maybe it doesn't make a difference not add too many more people. But do that soon. I don't know if I set a deadline, but do that soon, and otherwise we'll just have the system do it, and you'll go on. And then finally on the, I guess the class, how we conduct it, and I think I changed most of this in the course schedule, but there'll be numerous times when we will not meet face-to-face at all, and that will be obviously exams. I think they've already been told that they should be online by the powers that be. Also, the review session, I think October 1st, Tuesday, right before that. I usually don't prepare a lecture, I just let you guys ask questions. We can do that online. And then when you're doing presentations, which will be a couple times, one coming up in just a couple of weeks, brief presentations, but rather than trying to gather 3 people up here and stay apart and whatever, that doesn't really make any sense. So rather than do that with group presentations, we'll just do those via Zoom, and I'll figure out how to use the breakout rooms if need be for that, or for the, I think we've got a workshop, so to speak, where you've got a chance to work on that. But since it doesn't make sense for everybody to come to class and get together, huddle up, we'll just do that via Zoom. So you'll see that on the schedule. So there'll be some times when you are, when there won't be a face-to-face option. But of course, this is not an online class, so that option will still be basically available. Any questions sort of on that, Administrator? That's sort of an early rejiggering or reevaluation of all this stuff, given the environment we're in. But any comments, questions, concerns, whatever? I'll look at the chat there if you want to do it that way. Those of you out Zooming. And if not, we'll soldier on. All right. So first thing I want to do is I want to revisit one of the questions or concepts that was on the quiz, and you'll see here the table we produced, right? Which for some interesting reason showed that every year. I don't remember which fund this was, but they showed the same gross and net IRRs, despite things obviously must have changed over a decade. And the concept that I was looking for there, and I sort of I try not to give too much credit if you just kind of throw out a bunch of terms, which might be correct but not answer the question. But the idea was specifically not just that IRR may be bad and that there are issues with it and so forth, but it's very specifically that the idea that early progress, early performance, high performance, is the gift that just keeps on giving. It just goes on forever because of the way IRR works. And I did an example here to show you kind of how this happens. So look at two funds, maybe that a Blackstone or some general partner has, and they get back a 50% return right away, and some other little numbers come in there to help, and they end up with a 53% IRR. Fund 2 takes a couple $100 out, also gets a 50% return, but that takes however many years that is, quite a few years. So now we've got, let's say, a fund sponsor where they had a 53% IRR fund and a 5.3% IRR fund, leaving aside the issues of whether we believe anything about IRRs, right, or even want to be bothered with them, which we do, since most of the world seems to want to be bothered by them and look at them quite a bit. What do we say the IRR is for this fund sponsor? Should we take 53 and 50 and 5 and add them together, divide by 2? What do you get there? About around a 30% IRR, right? Would that be a fair number? But look, if we take those same cash flows and put them in this other chart, one after the other, and it's the same cash flows, right? But the IRR is 45%, right? So even though they had a follow-on fund that was not very good from an IRR standpoint, it didn't really matter because these early cash flows matter so much. So that's the idea. That's many ideas. One of the many reasons that Filippo is skeptical about IRRs, but that specifically is what he was looking. Why the Yale numbers and other funds, I think Blackstone or Apollo was one that he looked at, why those result in what they result in. Now, the other thing I wanted to make sure that we clarified, because some of you use words like fraudulent and so forth. All of this and this math, if you will, is absolutely legal. And I would say most of the things, maybe all, well, not all, of course, but most of the things that private equity funds do that we might be skeptical about, they are not necessarily not legal. For example, one is the presentation of IRR like this. This is just the math that results when you add up this fund 1 or report this fund 1 and this fund 2. Sorry about that, guys. Didn't realize we weren't live here. Another example of something that's not fraudulent at all, but that can be worrisome, is this idea of generating a big return, increasing your IRR by generating a big return quickly. Now that's not something, that's something that an auditor would, and any fund that takes any institutional money or wants to take institutional money in their next fund, they're audited. Okay, those cash flows had to have happened, and an auditor wouldn't come in and say, well, you shouldn't have sold that company so soon. That's not their place. The same way a financial auditor would not come in, a CPA firm would not come into a regular operating company and say, you shouldn't have built that plant there because that wasn't a great idea. Now, if they were a consulting project, fine, but as an auditor, they wouldn't say that. So I just want to make sure you understand, these are legal and standard practice, and I don't mean, they're okay because everybody does them. I mean that that's just the way it's evolved, and people on both sides are allowing, on the investor and the GP side are allowing and using IRR more than they should. But I can tell you that any fund that has taken institutional money has gone through, and I mean of any size, unless it's Joe's pension fund and whoopee cushion parlor or something. But if it's a real institution, they come in and examine the books, and they will not just ask, did you have Ernst & Young in here to audit it? They'll also say, gosh, I see how good your IRRs are. I see all these early exits. Why did you make the decision to sell that investment so soon? Now, how good they are at asking those questions and listening to the answers and evaluating the answers is a different issue. But realize that that's a tension. It's an opportunity for gaming. But, who's to say that when they sold the company after just a year, that they weren't excited by the results, thought that the buyer was paying plenty. I've sold a couple of companies within 2 years, and it was just one of those, things are going well, we've done a lot of what we said we would do, and there's somebody out there who will pay us, a much bigger multiple on higher EBITDA than we did. Forget the IRR clock or whatever. Let's take some money. Let's make some money. So I wanted to is to bring forward the realizations, right? Let's get that cash back in, or I should say back out to the limited partners as soon as possible. The other is to delay when the money comes in from the limited partners, because the limited partners, again, are, they're looking at, they're making this calculation or this calculation, right? Just the IRR calculation. So another way to game that, which this example, right? Think how much better the IRR is if instead of taking this $200 down at what we call, just time zero or whatever, what if they could move it out a little bit? Right? I don't know what that particular would do to the IRR, but it would certainly help it. And then they make a capital call in good time, and pay back the loan. So now there is also one more issue that I failed to bring up, and Warren Buffett has been concerned about it, and this is a relatively new practice. Again, legal, although limited partners are not necessarily happy about that. And if you think about how can I goose IRRs, well, one way, of course, again, legal, but he even said it legal, but kind of nefarious maybe, is a private equity fund will make an investment. They won't call the capital, but they'll borrow money at the fund level, and they may wait a little while, maybe too long, maybe a long while, and then they'll make the capital call. So add that to the interesting, weird, legal, but this one particular is probably iffy. I think Warren Buffett may have called them out on this one, but I wanted to add that to our list of stuff that goes on in private equity. So let's talk about valuations. And I used to talk a lot more about valuations and DCFs and so forth, and I'm gonna try to be more of a laser focus on the leverage buyout way of valuing investments and the venture capital way. And first, we'll talk, of course, about leverage buyout. So you've seen this about 3 times or so maybe you'll memorize it like I'm about to. Multiples are going up. Enterprise value to EBITDA multiples have been going up. Depends where you draw the line, but at least a decade or so, and are at sort of higher levels than that goes in maybe forever. So how do we value a company? So we're going to focus on enterprise value, equity value, and then when we get into venture investments, we're going to talk about pre and post money, but not for today or the next few weeks. Now we'll talk about that more in a second. So the key to the enterprise value is the value of the entire business enterprise without referencing the capital structure. I'll talk about value. We know what that is. It's just what's the equity worth for a publicly traded company? That's number of shares outstanding times the stock price, right? That in a minute. And then it is more difficult valuing private businesses. We may or may not have comparables. We don't expect to have a daily public market pricing. Shares may be illiquid. Certainly in almost any private company, they're more illiquid than in publicly traded companies, which deserves a discount. And with that discussion of how much of a discount is part of that valuation process. You have some companies that aren't generating cash, and even larger companies. We talked about how many companies failed to meet the operating margin improvements that they were expected to meet. So all sorts of issues, and that's why you'll see in a lot of times in fairness opinions and so forth, you'll see a valuation range rather than a specific price because they just don't know, or it's tougher to stand a certain price. So the VC method we'll talk about later, a couple weeks. The DCF analysis you may have seen, but it's a theoretical present value based on the future cash flows of the business, and the key there is that you're discounting by the cost of capital. If you remember the cost of capital idea, you take a bond rate, you take a cost of equity, you do a weighted average, so on and so forth. Always interested in the comps. If there's a publicly traded company out there, or merger transactions that have just happened or have happened in a reasonable enough period of time to be interesting, we want to know what's going on there. Because can you justify paying 10 times EBITDA for something if there have been a bunch of transactions, or the public market is valuing them at 8 times? That's something as an investor. If you're reporting to anybody, or if you're just reporting to yourself, you got to ask, how am I justifying that if I'm differing from the comps? And certainly you need to know what the comparable companies are. And then what we're going to focus on though is an LBO analysis. The LBO analysis says we're going to take the cash flow generated by the company. We're going to look at, obviously, net income, but we're not going to pay a lot of attention to that measure. We're going to add back and get to all the cash flow that we think this company can generate over the, let's say, 5 years. After building up working capital, maybe, they've got to build up inventory and so forth. The key thing, and the difference between that and the DCF analysis, is that in the LBO analysis, we're going to try to guess if we don't have the information, what is the capital? We're going to use the capital structure that we actually think we're going to use. So if we think we have to put 40% of the purchase price down in equity, and we can borrow the 60% at 6% interest, that's what goes into the model. We're not guessing at what's the risk-free rate plus beta times whatever. Nobody does that I know of. realistically. This is how much we have to put in. This is the return we want to get on that equity. And you got to start with at least the 15% number and go up from there depending on how risky things are. And then you can talk to a bank. Certainly if you're a fund, you're in constant contact with the credit markets. So you know that, yeah, they'll lend us 60% of what it's going to take to buy this company, and they'll lend it to us at 7% or whatever the number is. So to talk about multiples, and the multiple, which is enterprise value divided by EBITDA, we've got to talk a little bit about what they are. So EBITDA, hopefully it's not a difficult concept. So we're going to take the earnings, but we're not going to include interest, we're not going to include taxes, and we're not going to include depreciation and amortization. So that's what EBITDA stands for. Have you all heard EBITDA much? Okay, so this is not a new concept, right? Now, by the way, Warren Buffett is not a fan of EBITDA, and he says, we don't buy a company when the managers talk about EBITDA. I'll bet he has, but that's what he says. And he said, this is a few years old, and he says that the terms never appeared in annual reports of companies like Walmart and GE. Well, I've checked, and it at least has appeared in General Electric's recently, so he's probably overstating his case. But his problem with EBITDA is just that it leaves out depreciation and amortization or capital expenditures, right? So two companies could have the same EBITDA. One of them could have capital assets of 100 million that it's depreciating. The other could have none, right? Have not invested underinvested or failed to invest or just hasn't had to invest at all and have zero depreciation, and they would have the same EBITDA. And he says, of course you need to have a measurement of the money that's going to go out the door for CapEx. And that measurement can either be depreciation and amortization, or it can be the actual CapEx. And what really happens is when you're doing an LBO model, you start with EBITDA, and then you figure out what the actual CapEx would be, regardless of how the accountants are treating the past CapEx or want to treat the future CapEx, except for the tax accountants, right? Because you get a break for depreciating assets. But we really want to know what kind of checks are they going to have to write? And that check may or may not every year. And that check for CapEx may or may not look like an amount the amount that the accountants say we've got to depreciate this by. And so he's not but he does use EBIT, by the way. Now, not only we're going to use EBITDA, but we're going to use adjusted EBITDA. And that idea is we're going to take out stuff that we don't think is recurring or relevant. Now, many of you may know that in accounting, there is a definition of non-recurring events, or forget what other titles they have for it, but there's basically a criteria where we say that's a write-off we can take. It's not something that's going to that really reflects our business going forward or in the past. So we're going to carve that out. In investment banking, private equity, and coming up with adjusted EBITDA, the criteria is basically whatever you can convince somebody the adjustment should be, whoever that somebody is, as opposed to a strict set of rules. That if you're accountant, you'll apply those rules. If you're an investment banker, you'll kind of see, well, what can we defend? What can we do without having people laugh at us? And let's that back, make our EBITDA larger. Now, this is from Dollar General, back when they were being purchased by KKR, At the time, one of our Georgia U.S. senators was running the company. That's just a trivia note, but not otherwise important. But look at what happened. Let's look at the fiscal year. So they were buying a company that, according to the financials in 07, had about $450 million of EBITDA. But they were paying, oh, now I've forgotten, they're paying a lot for this company. I've forgotten it at the moment. They were paying a lot for this company, and it was really not going to be supported by the price they were paying was not going to be supported by $450 million of EBITDA. And in fact, you can see it's a lot less than years prior. And if you look back and think about it's 07, it was really basically 06. We really hadn't started weren't too far into the meltdown in the economy. So that's kind of weird that it went down from 750 down to that. But this is, audited financials. And furthermore, when the economy does go down, then we expect the Dollar General to probably do okay, right? Because people are shopping at Walmart, downgrade to Dollar General. Hard to believe there is some place where you can downgrade from Walmart, but in fact, we have dollar stores for that. So in order to get this deal financed and be more accurate, they would argue, they said, we're going to come up with adjusted EBITDA. We're going to go through and take things that really don't belong here or aren't going to happen again, and we're going to add or subtract them back. So the first thing, this was back during the time of Hurricane Katrina, and they said, we got some insurance money because of Hurricane Katrina, but we also have to take that out. We have to deduct that from EBITDA because we don't expect to get insurance money from a hurricane every year. So that's actually an adjustment that lowered EBITDA on their way to getting to adjusted EBITDA. But most of the rest of these are positive numbers. So they said, well, we got some expense. I'm sure they had some lack of insurance for stores, maybe damage, or they had to move stuff around. There were some expenses associated with that. Again, not a big number here. But then they came up and said, we've got a bunch of stores that aren't performing, and we're going to close them. And when we do that, and we've identified them, and when we do that, we're going to add $15 million. We're going to save $15 million a year because we got some stores that are so far off the beaten track they don't make any money. So we're going to add that back. And by the way, if we close some stores down, we maybe don't need so many people in the head office and some other costs there. So there's another 33 we're going to add back. And then the biggie was what they called Project Alpha, and that was detailed here below. A big part of that was markdowns. They'd taken markdowns when they were closing stores and reevaluated the inventory. And so believe it or not, when you're trying to sell a tube of toothpaste for $1, it actually can go bad, I guess. I don't know. I think they starts out being 2 years old. But anyway, they were able to say, we're going to mark down a bunch of this inventory, or we did, and we're not going to do that every year. So let's add that back. So you do all sorts of this stuff, and voila. EBITDA from 448 to 646, huge percentage increase. We're borrowing money at a multiple of that, 6, 7 times. 200 million times 6 or 7. A billion there, and pretty soon you're talking about real money. So that's the idea behind adjusted EBITDA, and you're going to see that in Morgan Stanley. And just one anecdote, I can tell you one time we worked on a deal. I was an investment banker for it, and they needed a bunch of adjustments to justify and to be able to underwrite the bonds, the junk bonds they were putting out. And their operating results kept declining as we went through the process. So their other investment banker um, would call the CFO of the company and tell her, we need some more adjustments. And she would say, it wasn't she, would say, we're gonna fire more people. It was a department store, big department store merger. We're gonna fire more people. We'll need less people for some reason. So add another $50 million to one of those lines. So it's just one of those things you've got to be careful of as to whether they are their companies, is they'll legit or not. My favorite for small, very small privately owned companies, there'll be a number in there for Braves season tickets and other stuff like that, and they'll add that back, and which is fine. You can understand that if they're taking their family there. But if you say, well, do you ever take customers to Braves games? Oh, all the time. We give them the tickets all the time, all our suppliers, all our customers. Well, it really shouldn't be an add back, right? It really shouldn't be an adjustment to EBITDA. Because if I buy the company, I'm going to want our sales manager or whoever to take those same people to the Braves game. And, so there are some that are legit, and you've got to really look at them if you're the buyer, line by line. And here's a chart, which I've cut off here at the end, but it shows you the percentage of buyouts with EBITDA adjustments. And again, you can draw another nice line there, so that it's becoming more common. So I'll do this with poll everywhere, or will I? To tell me what the projected, and it's actually adjusted EBITDA, but the projected EBITDA is for Harley-Davidson, based on this, for the year the year that we're in, the year of 2020. So we're going to underwrite this based on adjusted EBITDA, right? Or we would suggest that it would be. And we'll certainly look at the projections going out. But this 2020 number would be important, because if we were looking at a Harley-Davidson LBO, and your LBOs that you're looking at, you're going to be really looking at calendar year 2020, if that's the year that they're on. But it's just going to take until the end of the year to get one done, hypothetically or realistically. It would take a year to get done. So when we try to close on December 31st, and we look back at 2020, this projected EBITDA is what we should have. And again, it's EBITDA. You'll see there's some other cash flow stuff in there, like CapEx, changes in working capital, right? If you build inventory, whether it's a motorcycle or motorcycle parts, if you build inventory, that takes cash. And remember, that doesn't show up on the income statement, and therefore it doesn't show up in EBIT or EBITDA. So we got to add that back. I'm sorry, we have to take that into account, which in the case of working capital, if it's a growing company, usually means you have to subtract that. You think about that. If you think you're going to increase the size of a company, increase its revenue, 10% a year for 5 years, and they are in a business that requires inventory, how are you going to do that without increasing inventory and having that cash go out the door? If you you either have to think they're doing a really bad job already, or you have to think you are very good at inventory control. And of course, that's just one component of working capital. I use inventory a lot simply because it's the easiest for me to think about. It's not abstract as receivables and payables. You're building inventory, you got to write a check for that, right? All right, we've got a lot of you weighed in. So so those of you who are not playing along at home, looks like 825 is the winner, but a lot of other numbers. And so all we need to do in this case is take EBIT of 592. And what's the difference between EBIT and EBITDA, right? It's depreciation and amortization. We're given that number. So we just need to add up 592 plus 233, right? So the EBITDA that we would start with in underwriting this company or evaluating it would be $825 million. This will pull everywhere and ask. And that's not any more helpful because I didn't write it. But anyway, 825. We would incorporate capital expenditures in our LBO model, of course. We can't ignore it. And we would be leery of a company that had a lot of capital expenditures in relationship to its EBITDA. I looked at a company one time that did a specialty trucking company, and hauled one particular product, which was another issue. But we offered 4 times EBITDA for it, if that was the number. And the investment banker, who was smart enough to know better but wasn't acting like it, said, how can you, this is an insult, how can you offer 4 times EBITDA? Look at any industry measure for EBITDA multiples, and they're not 4 times. Well, the problem was that these trucks wore out, particularly the engines, and so you had to buy trucks all the time. So your EBITDA might have been X, whatever it was, but that number got cut way down by required capital expenditures, because you can't just let trucks go by the side of the road. You have to, it's capital expenditures you have to have just to maintain the business. So, our 4 multiple was probably really a 6 multiple on EBITDA minus CapEx or something like that, which is why we weren't willing to pay more. And deal didn't get done, and I love looking at things we passed on or not been able to reach agreement on after, just to see if we were, quote, wrong. And he ended up not selling and going bankrupt like 2 years later. So I think there's a German word, Schadenfreude or something, I can pronounce. So we were right. Now, enterprise value, are we okay on EBITDA? Anybody out there in Zoom? Okay. Let's talk about enterprise value. So this is what you'd pay for a business which has no debt, no cash, right? It's the check you would write. And here's the formula, but I want to make sure that, since we're going to be talking about this a lot, and it's relevant really even into our venture capital discussion, I want to make sure we're very clear on this. So when Warren Buffett says, I'm going to buy your company for $200 million, what he says is, or what he means is, I'm writing a check for $200 million. And I want you to turn over a company to me that has no debt, and I don't really expect it to have any cash. And I expect it to have the normal accounts receivable and inventory, that you haven't done anything weird with that. And so I'll get those as part of it. And I'll get all the other assets of the business as well. And if the seller says, well, Mr. Buffett, I have $70 million of debt on here, Warren Buffett says, that's interesting. I don't care. I'm writing you a check for $200 million for your entire business, and you'll have an obligation, of course, at the closing table to take 70 million of it and pay it out to your lenders. But I don't care. They're not my lenders. Warren Buffett basically doesn't have lenders because he's got it. His firm, Berkshire Hathaway, has an extra $100 billion of cash right now. The similar way, and what Warren Buffett would say is, I agreed to pay you $200 million because you generate 20. He wouldn't say EBITDA, right? But you generate $20 million of EBIT, and the right multiple is 10 times for that, and so I'll pay you $200 million. And your debt load doesn't come into that. The other example I would give you is if you're selling your house and it's worth $200,000. I'll assume it's not 200 million is not a good number to use, and that it's worth $200,000 because the houses on each side have both recently sold for $200,000, and you have the same darn house, all right, same lot, everything. Even though you think yours is better, it's not. When a buyer comes in and says, I'll pay $200,000 for it, he means you're going to turn over the house with no debt, and there's not going to be cash in the floorboards or laying around on the kitchen table or anything, and he'll get ownership of the house. And if you come to the buyer, and say, but I have $180,000 of debt on this, the buyer says, that doesn't change the value of your house. It changes the value of your equity. Now your equity is only worth $20,000, right? 200 minus 180 of debt. But that's between you and your lender, because when people buy houses, they very rarely ever assume the seller's debt, right? That's, it's a personal obligation of the seller. They arrange their own financing unless they're writing a check. And businesses do that the same way. There are times when the debt that's on a company's books can be assumed by a buyer, but most of the time, that's not the case. Because most of the time, the lender has said, whether it's a junk bond lender or a bank lender, has said, just as they've said, I'll lend money for your house to you because of your credit rating and the value of the house, banks say to company owners, we'll lend you this amount of money based on the value of the business and the fact that you're running it. Maybe you're putting a personal guarantee on it if it's small enough or necessary. But based on everything, if you change that dynamic by having a private equity firm come in and buy it and leverage it up, we're out of here. Or you got to renegotiate things. So as a leveraged buyout buyer, we can't count on, and we don't really care about the debt that's already there, except for, that says cash, by the way. I'm going to get rid of that. The only reason as a buyer we care about this is we want to make sure this equation is understood. And in the case of a publicly traded company, this market value of equity is out there. It's a number we know. If we're buying a private company, there may not be anything such thing as a market value of equity. We don't know what equity's worth or what he thinks it is. We just know, based on an EBITDA multiple or some other way, but we'll stick with that, we know what the enterprise value is. So when we look at a publicly traded company like Harley-Davidson, we're going to, and we want to know, what do we need to pay for that? Well, eventually we'll be talking to the board of we will be talking to the board of directors and negotiating, trying to negotiate a deal. But in the meantime, we know that if the market value of the equity is, $4 billion, and they've got, and they don't, but let's just make it easy, and they had, $5 billion of debt. Let's forget the cash for now. We know that if we don't show up with $9 billion, it's unlikely we can buy Harley-Davidson. Now, there are things instead of takeovers called take-unders, where you say the $4 billion of equity is nice, it's not worth that, we're going to write a check for less than that. They're called take-unders, and they're not looked upon favorably by a seller or a board of directors. So if you're looking at Harley-Davidson or any company, and the company, prospective companies for your leverage buyout, you need to look and see what's it trading for, what's its enterprise value now, to know what check you're going to have to write, because chances are you're not going to be able to write one for less than that. And in fact, you're probably going to have to pay a premium over the equity of, let's say, 20%. Can be a huge range. Let's just pick that number because it's an interesting one. So another poll everywhere number. Now watch your decimal points here. But recently, Apple had a stock price of $460, so a week or so old. I don't know what this, lots changed. And they had 4.28 billion shares outstanding, which means that the market value of the equity is $1.9688 trillion, almost $2 trillion. This has actually become a fairly bad example because of all the decimal points, which you don't need in an ordinary company. But the question is, given these assumptions, what's the enterprise value of Apple? We know what the market value of the equity is, because we just calculated that. But what's the enterprise value? And I'll activate that in Poll Everywhere. And a note, in case anybody's not watching or not here and is just sending in nonsense answers, not really going to do you any good. And it's kind of obvious. Just throw that out there. We've got 11, and we've only got about 13 people here, so let me go on to the next slide. So it is 2.08 trillion, and again, it's just applying this formula. Let's do one more. So let's do Hog. And here are the things we know about them. That's 834. So we've got debt, stock, all right, so we just take the 4.88 and add the debt and subtract the cash. Now this is a little unusual in that they have more cash than debt. Usually that's more a feature of high-tech companies or a company like Warren Buffett's. Think of it if you were buying the company, what check do you have to write? And of course it is the enterprise value. But conceptually, you're going to have to write a check to pay off the shareholders. They're not going away unless you pay them. You're going to have to pay off all the debt, right? Because you go to jail if you try not to. And then assuming that cash is not needed in the business, and that's crucial, we're making that assumption, you then could buy the company and keep the cash. Or put another way, you could use the cash to pay off the debt and net those two out, and you would still have some cash left over. It's kind of like the house equivalent of, I'm going to pay $200,000 for the house, but there's some money under the floorboard I'm going to get to keep, right? And the key is that cash not be needed to be used in the business. So if we needed it, then you're not going to be able to use it to pay down debt. For example, if any of you are familiar with Groupon, people still doing Groupons? Right? No, not a lot. Not like it used to. But Groupon, of course, you pay for the coupon or the Groupon to Groupon, and then when you get your teeth cleaned or sky jump or whatever it is you're doing through Groupon, they pay the vendor. Well, that cash they've collected from you, they do need to run the business, right? They can't. That cash can't go out the door. That's being reserved for meeting its obligations. So it'd be the same thing with if people still did magazine subscriptions, right? You paid for a year worth of magazine subscriptions. The magazine company has your $12, but they still owe you, a year's worth of Popular Mechanics or whoever still publishes in print form. All right. I'm going to skip that one and look at that at your leisure. So just to emphasize this EBITDA idea, I can tell you that when my children were young, they would run around the house. The two girls would run around the house yelling EBITDA, EBITDA, because they'd heard me use it on the phone so much, saying, well, what's the EBITDA and what's the EBITDA multiple? And I did not name either of them after any financial terms, though, including EBITDA. So I want to take some time, a little bit, just to preview what we'll talk about in more detail. But how do we make money? How do we make money in private equity? And it's a component of increasing earnings or EBITDA. It could be a component of getting a higher multiple of that and of paying down debt. And one of the reasons why this whole thing kind of works, despite these higher multiples and all the fees and everything, is just take an example. Suppose I've got a company that generates $10 million a year, and you buy it from me for $100 million, and the $10 million it generates really is free cash flow. You can pay it out. So you buy this company from me for $100 million. You collect $10 million every year. So it's 10 times multiple, right? You collect $10 million every year. And then 5 years later, you sell it, still generating $10 million, and you sell it for $100 million. So what's your IRR or your rate of return or whichever number you want to call it? It's the same number. If you buy something for 100, collect 10%, collect 10 million for 5 years, and then sell it for 100. Right? Shouldn't take a calculator. You pay me 100, company pays you 10 million a year, and then you sell it for 100 million. What's your rate of return? It's got to be 10%, right? Okay. So that was an example of paying 10 times for a company with no leverage, right? I'm assuming you wrote a check for $100 million, no growth in EBITDA, and no growth in the multiple. So the three ways that we're hoping to make money, increasing EBITDA, increasing the multiple, or paying down debt, were not relevant. Didn't happen here, and we still made 10%. So now imagine, that something good happens, or that it's leveraged. So now instead of writing a check, and I'll use the example now on the slide, right? So your enterprise value is 990. In this case, it's euros. This is just out of your book. And you fund it with a check, an equity check for 440, and you borrow 550. So you're in at 9 times EBITDA, and you borrowed 5 times EBITDA in debt, which is not a terribly high number. Of course, we don't know what this company does, but it's not a terribly high number. And then a few years go by, I think this is 4, and EBITDA is not 110, it's now gone up to 150. You sell it for 10 times that. So you sell it for $1.5 billion or 1,500 million, right? So just on the enterprise value, you've made some good money, 500, but you didn't write a check. You didn't write an equity check for 990 million, right? You wrote a check for 440. So now, if you're doing an IRR calculation, it's negative 440. Presumably no dividends for, I guess it's 4 years, 11 to 15, right? 2011 to 2015. So you wrote it, your negative check is 440. Your positive check that you get back is 1,500, except that your debt's now down, or you still have debt, and it's down, but it's down. So you now have to take 300 out of that, which is the remaining debt at the end of the four-year period. So you're going to get back 1,500 minus 300, or 1,200. So if you run a calculation of 440 out the door and 1,500 minus 300, or 1,200 back in the door, or does that make sense? 440 to 1,200, about a 2.7 multiple of money, right? And the IRR 28.5%. Right? So that's the magic, right? Now going from 110 to 150 of EBITDA, it's less than 40% over 4 years, but that's right. That's close to 10% a year. So that was not insignificant. The EBITDA, enterprise value multiple, EBITDA multiple, just went up by 1, right? Not incredible, not a ridiculous or crazy idea. One you want to be very careful about in your models and in any is having that number go up if you don't have a good reason for it. And then that amount of debt being paid down, I don't have the calculations underneath it, but probably not bizarre. So you can pay 9 or 10 times for a company with, I'd say that might be a normal amount of leverage. And so you've gotten returns in 3 different ways. And here's another example. I think this is out of your book. I should have that noted. Where on the left, you buy, in both cases, you're buying a company with 100 enterprise value of 100 at 5 times multiple. In this case, you've got no debt, so your initial equity number is negative 100, and then you're going to get 200 out of it. And 5 years, doubling your money, right, is a almost 15% IRR. Not bad, but if we can get 50% leverage from it, and EBITDA goes up by the same amount, we're gonna write a check for only $50 million, right? And we're gonna get 150 out of it. Sorry, those numbers are not trying to blend together. So just by applying 50% leverage, we've moved our multiple invested capital up from 2 to 3, and our IRR up from 14.9 to 24.6. So now you can see why leverage buyouts will pencil out because of the leverage. And when we get to environments where there's less leverage available or no leverage available or what have you, LBOs slow down or stop happening, because 14.9, I don't know that that quite does it. But if I can get a company and make a 24, close to a 25% IR, that gets pretty interesting. So this little chart and the preceding one should make because we're going to be looking at models, developing models, or filling out models, where you just need to be aware of these components, so that if the number is too small or looks unrealistically large, you can go in and say, we need to tweak this. And that's where people, quite frankly, a lot of times get in trouble, is they want to make that 24.6%, their hurdle rate is 25%. So all of a sudden, the EBITDA goes up by a little bit more, or the multiple goes up, or what have you. And those are the things that you'll need to look at in your model, and I'll be looking at to see, kind of how you made it work. And some people think that's the job of investment banking analysts, is to make every deal work that they need to and hide it in the numbers, which it's to you because is at least a gross oversimplification. So for next time, we'll ask a question like this. If we did pay the current price in the market for the enterprise value, again, not just the stock, the enterprise value of HOG, and at the end of this year, basic question is, what's our EBITDA multiple, right? And that's kind of, you got to be able to calculate and get very comfortable with. So that's all I've got, and our time's up. Questions, comments, anything from the peanut gallery, or I guess as we say, our esteemed Zoom participants? If not, then thank you, and see you all Tuesday.